Hey everyone, welcome back to the AI Tech channel. Today, we're diving deep into the high-stakes world of semiconductors and asking a crucial question. Is NVIDIA's lead in AI chips truly unassailable? We're not just talking about market share, we're talking about the very future of AI innovation. Forget the hype for a second. Hidden within the financial data, a startling trend reveals that competitors are gaining ground faster than anyone expected. Can NVIDIA maintain its throne, or is a seismic shift about to rock the industry? Let's get into it. For those new to the game, NVIDIA, a graphics processing unit developer, its GPU used to enhance experience on computing platforms, most notably in gaming applications on PCs. But things changed. GPU use cases have since emerged as important semiconductors used in artificial intelligence. NVIDIA not only offers AI GPUs, but also a software platform, CUDA, used for AI model development and training. NVIDIA is also expanding its data center networking solutions, helping to tie GPUs together to handle complex workloads. So, NVIDIA is a big deal, no doubt. But the question is, how big of a deal compared to everyone else? All right, let's crunch some numbers. We're going to compare NVIDIA against its main competitors in the semiconductors and semiconductor equipment sector using key financial metrics. We're talking price to earnings, price to book, price to sales, return on equity, EBITDA, gross profit, and revenue growth. These aren't just numbers. They're clues to understanding the true health and potential of these companies. What we're seeing paints a fascinating and, frankly, a slightly concerning picture for NVIDIA. First up, the price-to-earnings ratio. NVIDIA's P/E is 54.97. Now, the industry average is higher, around 76.66. This could suggest that NVIDIA's stock has potential for growth at a reasonable price. But don't jump to conclusions just yet. A lower P/E doesn't automatically mean a bargain. We need to look at the bigger picture. Think of it like finding a used sports car for cheap. Is it a steal, or is it hiding some serious engine trouble? Next, let's examine the price-to-book ratio. NVIDIA's PB is a whopping 51.74, significantly exceeding the industry average of 6.42. This indicates that NVIDIA might be trading at a premium relative to its book value. In simpler terms, the market is valuing NVIDIA's assets much higher than their actual worth. Is this justified? Are NVIDIA's future prospects so bright that investors are willing to pay a premium? Or is this a sign of overvaluation, a bubble waiting to burst? The tension is rising, isn't it? Now, let's talk about the price-to-sales ratio. NVIDIA's PS is 30.56, more than 3 times the industry average of 9.72. This is a huge red flag. It suggests that the stock could be overvalued compared to its sales performance relative to its peers. The market is betting big on NVIDIA's future sales. But is this bet based on solid ground, or is it built on hype? The stakes are getting higher and higher. Okay, some good news. NVIDIA's return on equity is 31.13%, significantly above the industry average of 4.07%. This suggests that NVIDIA is efficiently using equity to generate profits. It demonstrates profitability and growth potential. This is a strong indicator of good management and a healthy business. But remember, one positive metric doesn't negate the concerns raised by the P/B and PS ratios. It's like finding a gold nugget in a minefield. Now, let's look at earnings before interest, taxes, depreciation, and amortization EBITDA. NVIDIA's EBITDA is $22.86 billion, which is lower than the industry average of $37.65 billion. This potentially indicates lower profitability or financial challenges compared to its peers. This is where things get really interesting. Despite the high stock valuation, NVIDIA's actual earnings aren't as impressive as you might expect. Are they spending too much on R&D? Are their competitors more efficient? The questions keep piling up, and the trend continues with gross profit. NVIDIA's gross profit is $26.16 billion, also below the industry average of $32.82 billion. This indicates that NVIDIA may experience lower revenue after accounting for production costs. This reinforces the concerns about profitability. They're selling a lot. But are they making enough profit on each sale? The pressure is mounting. However, hold on. NVIDIA's revenue growth is a staggering 93.61%, far surpassing the industry average of 7.83%. This demonstrates robust sales expansion and gaining market share. This is the key to NVIDIA's story. They are growing at an incredible rate, outpacing all their competitors. But can they sustain this growth? And will it be enough to justify their high valuation? The tension is palpable. Let's talk about the debt-to-equity ratio. NVIDIA's D/E ratio is 0.16, significantly lower than its top 4 peers. This suggests a stronger financial position relying less on debt financing. This is a major advantage for NVIDIA. They have the financial flexibility to invest in future growth without being burdened by debt. But even a strong balance sheet can't guarantee success in this cutthroat industry. Let's bring in some competitors. Broadcom, for example, has a P/E ratio that is astronomically high, indicating a potentially overvalued stock. Their revenue growth, while substantial, doesn't match NVIDIA's explosive expansion. Broadcom is a major player, but they're playing a different game than NVIDIA. They are more diversified, but less focused on AI. That's a critical difference. Then there's Taiwan Semiconductor Manufacturing Company, TSMC. They have a more reasonable P/E ratio and a solid revenue growth. But they're a manufacturer, not a designer. They make the chips, but they don't create the AI magic that NVIDIA does. They are essential to the industry, but they're not direct competitors in the same way. Qualcomm, with a lower P/E ratio, appears potentially undervalued. Their revenue growth is respectable, but not as impressive as NVIDIA's. Qualcomm is a major player in mobile technology, but they're still trying to catch up in the AI race. The pressure is on them to innovate and compete. Finally, let's look at Advanced Micro Devices, AMD. They have a high P/E ratio, suggesting potential overvaluation. But their revenue growth is also strong, indicating they're gaining ground. AMD is NVIDIA's closest competitor in the GPU market, and they're pushing hard to challenge NVIDIA's dominance in AI. This is where the real battle is happening. NVIDIA's true strength lies not just in its hardware, but in its AI ecosystem. Their CUDA software platform is the industry standard for AI model development and training. This gives them a huge advantage. Developers are already familiar with CUDA, and they're more likely to stick with it. It's like being locked into a specific phone operating system. Switching is a pain, even if the other option is better. Looking ahead, the demand for AI chips is only going to increase. As AI becomes more integrated into every aspect of our lives, from self-driving cars to personalized medicine, the need for powerful and efficient processors will skyrocket. NVIDIA is well-positioned to capitalize on this trend, but they need to stay ahead of the competition. The future is uncertain, and the stakes are incredibly high. Many analysts remain bullish on NVIDIA, citing their strong leadership in AI and their innovative technology. They believe that NVIDIA's high valuation is justified by their future growth potential. They see NVIDIA as a long-term winner in the AI revolution. But are they being too optimistic? Are they ignoring the warning signs? Other analysts are more cautious, pointing to NVIDIA's high valuation and the increasing competition in the AI chip market. They worry that NVIDIA's growth may slow down, and their stock price could correct. They advise investors to be careful and to consider the risks. Are they being too pessimistic? Are they missing the big picture? Ultimately, NVIDIA's success will depend on their ability to continue innovating. They need to develop even more powerful and efficient chips, and they need to expand their AI ecosystem. They need to stay ahead of the curve. The semiconductor industry is incredibly dynamic, and complacency can be fatal. NVIDIA needs to keep pushing the boundaries of what's possible. The pressure is immense. So what does all this mean for investors? Should you buy NVIDIA stock? Should you sell? The answer is complex and depends on your individual risk tolerance and investment goals. If you're a long-term investor who believes in the future of AI, NVIDIA may be a good investment. But be prepared for volatility and potential downside risk. If you're a more cautious investor, you may want to wait for a better entry point or consider investing in other semiconductor companies. The decision is yours, but make sure you do your research and understand the risks. The future of AI chips is incredibly exciting. We're on the cusp of a new era of technological innovation, and NVIDIA is at the forefront of this revolution. But the competition is fierce, and the challenges are significant. Only time will tell who will emerge as the ultimate winner. The journey is just beginning, and the stakes are higher than ever before. So what do you think? Is NVIDIA's AI chip dominance truly unshakable? Are competitors closing in? Let me know your thoughts in the comments below. And don't forget to like and subscribe for more in-depth analysis of the AI and semiconductor industries. Thanks for watching.